Right, hopefully we are now live. Welcome to the Fiera Real Estate Debt webinar. My name is Charlie Allen and I am Head of European Real Estate. Thank you for joining us today. We are going to spend the next 30 minutes or so talking about the opportunity in real estate investment debt, focusing in very much on the investment opportunity and the key themes around that. At the end, we will then have some Q&A, and you should see on your screen a question box. So please feel free to send over any questions and we will endeavour to answer as many of those as possible. I'm joined on the call today by two specialists within the real estate debt space, one on the principal side and one on the advisory side. Both happen to be called David, so we'll try not to get confused. But starting with David Renshaw, would you like to briefly introduce yourself?
Thank you, Charlie. My name is David Renshaw, and I'm co-head of Fiera's European real estate debt business, which is headquartered in London in the UK. Over the last 15 years or so, I've worked in the real estate industry, both on the equity side and also on the finance side for banks, asset managers, and latterly over the last circa 8 years for alternative debt funds. So I've seen the growth and the explosion in the opportunity in terms of alternative real estate debt lending. I joined Fiera in September 2022 in order to set up and establish Fiera's European debt platform. And since then, we've raised our inaugural fund. We also run a separately managed account on behalf of a Middle Eastern investor. And crucially, both strategies are focused on what we call the senior secured real estate debt space, or whole loans, as they're sometimes known in the industry. Passing over to David Gingell.
Thanks, David. So David Gingell, as Charlie pointed out, I'm the non-Fiera part of this trifecta. I am the co-head of our EMEA platform, debt advisory platform here at Cushman & Wakefield. Like David, I actually sort of made the move from banking to non-banking. My journey started slightly earlier, so I made that move back in 2012. And we can come on to that and just how that sort of, actually preparing for this session today, just sort of reflecting on how that sort of tied into what's happened much more broadly in the market. So good to join you today.
Right, thank you guys. So just to very briefly kick off, quick introduction on Fiera Capital. So Fiera Capital is a Canadian listed investment manager. We have about $116 billion under management, and that is really split between public and privates. We're very much a global business. And within that, we manage about $7.6 billion in real estate on both equity and debt strategies. And that spans about 13 strategies and about 60 investment professionals. David, do you want to introduce the real estate business?
Sure. So one of the attractions to me in September 2022 when I joined Fiera is, number one, you're joining a global real estate business, inherently understands real estate. But on top of that, we also run a global real estate debt strategy as well. And I think the graph that you see, or the map that you see on the right-hand side, depicts where we have European real estate debt expertise and exposure. So that covers Canadian real estate debt, US real estate debt, Australia and New Zealand real estate debt, and obviously where I sit and what we run here, which is European real estate debt. In total, we have roughly $1.6 billion AUM across those four strategies. Two are more mature than others. The European and the US real estate debt strategies are growth strategies, whereas the Canadian and Australian and New Zealand debt strategies are long running and very successful real estate debt strategies. But like I say, global real estate debt is part of Fiera's DNA. We have a global team of investment professionals, and we very much understand the product and want to grow in this space.
Great. So we're now going to explore some of the key features of the European real estate debt markets, and in particular, how it could be attractive for investors over the coming years. David R.
Thanks, Charlie. So what you're seeing on this slide here effectively is the lending landscape across the US, the UK, and the EU in terms of types of lenders. What the chart on the left-hand side shows is that the US real estate debt market is the most mature, diverse market. It also has the highest proportion of non-bank lenders. Sitting in the middle, you have the UK. Alternative lenders, or the alternative lender market share, has grown from roughly 4% in 2013 to 16% in 2024. And I've really seen the explosion of that growth story, having worked for an alternative debt fund since 2016 up until now. And then on the right-hand side, you see the EU lending landscape, where banks still very much dominate that landscape. And you can see that alternative lenders make up a very, very small proportion of the overall real estate funding landscape. And I think from my point of view, this is where the real opportunity lies over the coming years. You're still going to see great opportunities in the UK, and the market will evolve to look more like the US market over time, and has evolved to look more like that over the last years. In the EU, you're going to see the EU market become more fragmented in terms of types of lenders, and well-positioned alternative lenders can really capture market share over the coming years. One of the main reasons for that is regulation on the one hand. And on the other hand, I think it's also the borrower community understanding that private credit can actually support them just as well, or if not better, than a bank can when it comes to actually borrowing aspirations.
Okay, thank you. Question for David G. How have you seen the private credit landscape grow over the last few years, and how do you see it changing in the years to come?
Well, so what I quite like about this slide is you've obviously split up into three geographies, but actually it captures three moments in time. So if I think about where we were sort of in the financial crisis as a European market, including the UK, we were on the right-hand side of this slide. It was just banks. It was banks, and more banks. And actually, when I made my move in 2012 to start the PGIM debt platform, really there were only three other non-banks out there. I think there was, and this is insurance as well as sort of the debt fund space. I mean, it was Aviva, Canada Life, and MetLife. That was really it. And so I think what's interesting about that is, if you have such a concentration of lending, which tries to be all things to all people, but also follows the same model, if that model for whatever reason fails, which obviously it did, it becomes systemic, right? That it compounds the issue in the underlying asset class, and that's what happened. And so there's been this tailwind, this fair weather movement towards a diversification of funding models, capital sources into what is a really attractive asset class. I mean, we all see and feel and touch real estate. That permeates sort of investment decisions as well. A lot more sort of investment decisions are less in the physical world and much less tangible and sort of esoteric. So I think for me, I like this chart because it sort of shows you, where we were in 2012, and that feels very much like on the right-hand side of this slide. I think, again, you see where you're going into the future. That was the second part of your question, Charlie. So on the left-hand side, the US, in many respects, whether you talk about finance, real estate finance or real estate equity, it drives markets, the way they approach things, the way they talk to investors. And so North American markets are just much more developed. And I do think that, obviously the GSEs are sort of semi, specific to the US, but a lot of what's going on there with investments, non-banks, and the bond market very much indicates sort of a healthy dynamic and one which I think is coming to a market near you soon.
Okay, interesting. Thanks. David R., aside from regulatory change. What are the other drivers of change that you see in the European real estate debt sort of markets?
Yeah, so I think this slide here touches on supply, or it does touch on supply. You know, where actually is debt capital coming from in the different jurisdictions? But if you actually flip that onto the other side of the equation, you have the demand side of the equation. So this is supply, and on the demand side of the equation, you effectively have an existing, in the EU market at least, a 2 trillion established commercial real estate debt market by volume. And that demand comes from ultimately from borrowers. And borrowers over the last 10 years have undoubtedly got accustomed to working with a variety of lenders, of which alternative lenders are just one. I guess what I'm saying is that if you go back 10 years ago, at times you would be speaking to a borrower in this space and they would view you skeptically as a private credit or an alternative lender versus a bank. They might see you as opportunistic. Whereas now I think, alternative lenders are well established, in large part as well, I think, by certainly in the UK market, by, a highly sophisticated sort of financial advisory system and broker community. And alternative lenders are now viewed very much as part of the lending landscape alongside banks. So that I guess addresses sort of supply, and then the other side of the equation, demand. The final point I would make back to the regulation piece, because regulation has been one of the key drivers of I guess this shift, if you like, from, as David Gingell said, from right to left in terms of how you look at the landscape. Banks are more often than not now wanting to actually partner with private credit firms, be it via loan on loan, be it via repo transactions, so back leverage effectively, because of the regulatory challenges, but also because they can then access, I guess, a diversified, originated, loan pool where they can have a look and they can see, okay, we will lend against these loans via back leverage or not these. They can rely on due diligence, and you can do that with a smaller pool, I guess, of HR, human resource capital, so people as well. So it's a mixture of things, really. So it's not just regulatory change. I would also say that it's borrowers wanting to work with private credit, and then it's also, I guess, just a shift in the fundamentals of how actually the real estate finance market works in the UK and across the EU. Where banks that traditionally lent directly to borrowers are actually happy to now lend to funds or to a pool of loans.
That makes sense.
Agreed. We've got some interesting questions coming in already around some of this, but we'll come back to those at the end. David R, do you want to talk us through this one?
Yeah, this is just very quickly on this one. I mean, I think obviously at the moment we're in a heightened interest rate environment. So obviously with the onset of COVID and heightened inflation, also geopolitical events as well, have led to central banks increasing base rates from their near zero positions, which they were for a decade. That obviously allows real estate debt investors to make higher returns versus what they were accustomed to or used to during the decade previously. And also the chart on the right depicts that actually these rates are going to stay higher for longer. So therefore, this is, people talk about higher for longer. I often view this as kind of back to normality because it depends how far back you go in time. I actually think the zero interest rate or the zero base rate environment was an anomaly. And what we're seeing on the right is obviously that you can, I think these heightened returns that are available in real estate debt will be here for the foreseeable.
Okay. David G, what effect do you think that higher rates have had on the transactional landscape?
I think from a rotational sort of perspective, people are investors have sort of looked at real estate and said, well, let's pause here and then think about what part of real estate to invest in. And to David's point, debt is an investable asset class. And so those returns relative to the risk feel somewhat asymmetric sort of in terms of outsized relative to the risk involved. So I think that's super interesting. As a broader theme, I mean, transactions continue, albeit at a slightly more muted level. I think the theme we see is, everyone wants to finance the baby, but, there are less people wanting to actually hold the baby, and own the baby. So I think that's kind of what we see on a day-to-day.
Okay. And actually, one of the questions David R. is going to ask you, and we've just actually had a question in which is very similar. How do you see appetite for real estate credit changing as rates start to come down over the next couple of years? Do you think this will make real estate debt strategies less appealing?
No, not at all. I mean, like I say, I've seen having worked directly for another well-established private debt fund prior to Fiera, that was in a zero rate environment. And when I was at that particular shop, I saw the explosion in private credit in a zero rate environment. So the product did work in a zero rate environment, and it will continue to work if rates drop off. And the final point I would add on that is if rates do drop off, you would expect to see more real estate transactions. So you would expect to see transaction volumes pick up again, particularly around new developments that do require leverage. And as a result, as a lender, if you're seeing more transaction volume, then by definition, you're going to have more choice in terms of what projects to lend against, particularly if you have strong origination capability and strong execution capability. So I'd flip that around actually and say, rates might drop off a little bit, but actually we would expect to see more opportunity, more deals to lend against, and that can obviously only be a positive.
Okay. So we'll now explore where we see the most compelling opportunities within real estate debt strategies. David R., do you want to talk us through this?
Yeah, so effectively what we're pursuing here at Fiera is a senior secured, or what we call whole loan, or unitranche whole loan real estate debt strategy. That's where we have conviction. The reason why we have conviction in the whole loan senior secured space, as opposed to, for example, choosing to invest into mezzanine products, is one of control. So all of our loans are structured with first ranking securities, first ranking mortgages, and obviously you have hard collateral in real estate as downside protection. So that's the opportunity. But if you actually sort of split that opportunity down into a subset, the subset of that opportunity, if you like, is on the one hand transitional lending to commercial real estate developers who are either developing ground up new buildings or repositioning existing buildings. We like that because effectively you're financing the build of a best-in-class asset with high ESG credentials, and that best-in-class asset, by definition, should have very, very high exit liquidity. So at the end of a loan life, you stand a very, very good chance to either be refinanced, or indeed, if the underlying borrower sells the asset, then at our sort of loan-to-value detachment points, you are comfortably repaid your money. And this is a space, by the way, that is often less crowded due to the regulatory pressures that we spoke about a little bit earlier, that are constraining banks and certain types of lending. And then onto the second subset, so number 2 at the bottom, where we're going to see a lot of opportunity, and when we do see a lot of opportunity is refinancings as well. So obviously, with interest rates going up over the last few years, borrowers have effectively a funding gap at the point of refinance on a lot of their positions. Now, some will be able to meet that with additional equity going into a deal. Others will need a mixture of additional equity and potentially a slightly higher whole loan. So again, a selective whole loan strategy in this space can be very, very interesting because you can cherry pick, I guess, best-in-class real estate assets that are facing liquidity pressures, and again, have that full control, full security, and first ranking mortgages. So they're the two, I guess they're the main space being first ranking senior secured whole loans, and then the two subsets that I've just discussed.
Okay, thank you. David G, question for you. are you seeing an increase in borrowers being offered whole loan solutions? Likewise, are you seeing an increase in refinancing requests? And how do you see the overall market liquidity? Is it good? Is it bad? Give us some insights on that, please.
I think liquidity is extremely strong. Honestly, I think, and what I like about it, back to the 3 pie charts, is because you've got that diversity of lender base, there's no sort of one sort of business model or funding source or style of capital holding the market stable. So I think for everyone, every market participant, including investors, that's only a positive, which is really strong. If you look at prime margins, really they're only 10, 15 basis points wide of peak cycle. So I think that's a really strong story. Obviously, base rates are elevated, but again, like if you need financing for anything from, the living sector, obviously very hot right now, up to, spec office construction, there is debt available for you. We, at any one time, track over 300 plus lenders active in the European real estate market. And whole loan is a very interesting feature there because you can raise a couple $100 million dollars or euros or pounds. You can lever that up, 80% advance, and you have very meaningful access to institutional real estate lending opportunities. And these people and these platforms, and yourself included, right? You're reflecting, borrowers want sort of clear answers. Borrowers want deliverability. It's pretty simple stuff, but a lot of the things that the market, in the wake of financial crisis, struggled to deliver. Lenders and borrowers, particularly in this elevated rate environment, are really looking for that and are prepared to pay a premium for it. That deliverability piece is critical.
Okay, and thank you, David R. We're going to move on to we're going to move on to the next slide. Do you want to talk us through this, the headlines, please?
Yeah, so I guess this is where, in terms of if you're evaluating, real estate debt opportunity and also real estate debt managers, these are the key things I think that you need to look out for. So obviously, in terms of pan-European opportunities, I think if you have a pan-European setup, you can take advantage of different jurisdictions being at different points in an economic cycle. So you can cherry pick. Sponsor selection, I think, as a real estate lender is super critical. You've got to pay, in terms of track record, deliverability, it's very, very important that you pay a close attention to sponsor selection. Asset classes, some are in vogue at the moment and some aren't. Our strategy is actually asset class agnostic, but we favor beds and sheds. Seniority of debt, we've already talked around. And then finally at the bottom, origination capabilities. I think in this market, it is quite crowded, undoubtedly, or it's grown crowded in the UK, less so in the EU. And I think the better performers in this space stand out through strong origination capability.
Okay. David G., are any of these investment themes, do you think, more important than others? And how do you think good private credit investors are able to distinguish themselves?
I think I answered this a bit early on the last slide, but I think deliverability is, I come back to that. And having spent most of my career as a lender and now sitting in a sort of intermediary role, just watching how different lenders sort of position that and position their conversations with investors as they kind of lead them through the investment process. That's a real skill, and some people get that, are really effective on that, and it is worth a premium to that investor, and it's also worth even more to the borrower. So I think that's a key theme. We talked about whole loans and just really being a one-stop shop for your borrower, like rather than having to sort of grab the mezz over here and grab the senior over here, in a market where, the sort of economics of finance are moving faster than the underlying real estate. It's hard to hit a moving target, right? So just the simpler you make it for everyone involved, the more likelihood you have to transact. So I would say they are key themes. And again, actually just in green at the bottom here, origination capability. Even at more established lenders right now, there is so much to look at, and so much sort of demand for your eyeballs to kind of really dig in something and really quote it effectively. I think that there's the ability to deliver that bandwidth for your borrowers, but also for your investors will likely lead to more success, because there's just not enough capacity out there right now.
Okay. David, do you want to talk us through, risk returns and how you see things?
Sure. So this slide here effectively showcases IRRs which are achievable across different types of real estate debt and equity on the right-hand side, risk profiles. It is of course ballpark, and it's probably a little bit more UK focused than EU focused, I would say. But what this shows effectively is that the sweet spot that we like at the moment at Fiera, which is effectively the mid-market and transitional development, whole loan strategies, can yield IRRs of between 8 and 12%, and that's on an unlevered basis, so with no back leverage or no leverage from banks or other financial institutions. And we like that space. That is heightened versus what we've seen over the last, let's call it pre-COVID, significantly heightened. And I think if you set that alongside, I guess, other returns that are available in this space, it looks very, very compelling from our point of view. We've got mezzanine at the moment at 10 to 14. We personally at the moment don't advocate or don't follow, a mezzanine investment strategy, just because of the bits that we've talked around before, which are control and seniority of security. And then I guess at the bottom left, you also have the traditional senior banks. Banks do still play in the traditional vanilla, long dated core debt. And that's not a space in which we're competing, because there, if we go back to the original slide around supply and regulation on banks, their banks are still undoubtedly, strong. So the sweet spot for us is the green shaded circle, which is mid-market, transitional or development-led lending on a whole loan, senior secured basis, and we find the risk return there very, very attractive.
Okay, David G, 30 seconds. Where do you see the best opportunities in Europe? Putting you on the spot.
Look, I mean, I think you're a pan-European platform. We operate as a pan-European business. The ability to transition in and out of these markets as you see value is super important. Right now the living sector, very hot, and that there's as many opportunities to match the number of investors who want to be in it. So I think that's super interesting. Obviously, we've all been reading about the data center sector and some of the volatility there, but also the opportunity. And again, office prior to the sort of the music stopping was 40% of transaction volume. So, it is a very relevant place to be. I'm in an office today. I look across, the offices are full across the road from us. So, that office class is going to be a very meaningful part of the puzzle going forward. So I think, again, it's just about remaining nimble. I think all of these sectors have opportunity.
Okay, great. So we'll now just, David, do you want to just very briefly just talk us through a couple of case studies where you just highlight some of the attractive investment themes that we've already been talking about during the webinar?
Sure. So, so David Gingell just touched on the fact that if you run a European platform, or if you work for a European house like he does, then you have the opportunity to pivot into sectors or asset classes or jurisdictions, as you see opportunity. Left-hand side is an example of high-level example of a deal that we have done in Spain. So lending against ground-up student development in a strong university city. The Spanish student market is undergoing huge growth because effectively there's a significant undersupply of purpose-built student beds. In the UK, we talk about student-to-bed ratios of 2 to 1. So clearly that is compelling. In Spain, you can see student-to-bed ratios in certain cities of 7 to 1. That means 7 students looking for one purpose-built for one purpose-built bed. The existing stock a lot of the time is church-owned or authority-owned or university-owned, and is quite outdated compared to the modern stock we're used to. So that's a sector that we like, and we've lent significantly into Spain pursuing that. And then on the right-hand side, we have an example of a logistics loan. Again, strong sponsor group, very, very institutional, long track record in this asset class. And obviously the demand for UK logistics in certain regions, in certain locations, is being driven or fueled by, e-commerce or online shopping growth. And that's shown resilience and liquidity, and that's a sector, another subsector that we like. Both of these positions are yielding gross returns of over 12%. Strong sponsor groups and look-through loan-to-values of less than 60% in each case. So I think, this is an example or a snapshot of what investing into a European real estate debt strategy can look like.
Okay, thanks, David. So we'll now move into some questions, and I've got lots here, so we're probably not going to get around to answering all of them, but we'll start working through them. So, David G, question for you first up. What is the role that ESG is playing in lenders' decision-making process?
Really, it seems to be an internet thing. Do you have the same bar at the bottom of yours?
I think we can hear you okay, David.
Okay, good. Okay, I'll keep going. Yeah. So, I think, to keep it brief, ESG is one of those things that's perfectly aligned right now with investment outcomes. And that's certainly the first time in my career that that's actually the case. So if you're in a European context, what is ESG? And really, you're talking about best-in-class buildings. You're talking about, spaces that appeal to, the best-in-class sort of tenants, and then the lenders as well. And I think that means that if you're trying to minimize risk and maximize outcome, lenders and lender liquidity is aligned with ESG. I think, obviously there's been some sort of, how do you describe it? Rationalization of that view, certainly from North American groups. They would just sort of describe it slightly differently, right? They want to lend against best-in-class opportunities, and by extension, in a European context, that's obviously ESG aligned.
Okay. David R, another question that's come in here for you. How attractive do you see real estate debt versus other asset classes?
Well, that's a tricky question to answer. Working in real estate debt, I see it as very attractive at the moment. I think it's going to keep on growing. I think the returns you can make at the moment are higher than anything I've seen, certainly in my career, for broadly speaking, very roughly speaking, the same level of risk, particularly if you have, good origination capabilities. I think one thing I would note is that I think real estate debt as an asset class can actually sit alongside and complement real estate equity as part of a balanced portfolio. I don't think if you're an investor, it necessarily needs to be either or. I think real estate debt has certain traits that make it very, very attractive. So it's low volatility, fairly short duration loans. Often you can, effectively recycle capital quite quickly. You have good downside protection in real estate debt versus, for example, certain types of corporate credit. So you have hard collateral. So I think real estate debt has its attractions, but I think, to say it's, how does it compare against others? It depends a little bit. I think it certainly balances or sits alongside real estate equity. It works in a balanced portfolio. And I think obviously it has similar attributes and can probably be, I guess, less volatile than certain types of corporate credit, and also can outperform fixed income as well if you have a look at the returns over the last 10 years. So quite a tough question to answer, but from a portfolio point of view, I think it can form sort of a cornerstone piece of any balanced, diversified portfolio.
Okay, thank you. I think we've literally got time for one more question. So David G, will we see more evidence of distress, lender-motivated sales coming to the market?
Look, I mean, I think with the financial crisis, I go back to this. Everyone kept talking about the wall of refis, the wall of credit, and where's that money going to come from? It just never happened. So, I mean, I think I'm cautious, in this sort of, it's not an equivalent cycle at all, but it's certainly sort of the biggest sort of reset that we've had since. I would suggest that, obviously there are elements to stress, and certainly lenders are taking action where two things are occurring or not present. One is an inability from the sponsor to put additional equity in, and one is an inability to work a business plan to optimize liquidity for the asset and get everyone out. I think if you can't deliver either of them, then we see, and you read it in the news, lenders sort of taking the appropriate action. I think more broadly, sort of things like NPLs and all the rest of it. I mean, it is very early to kind of make a judgment on that, and I right now that doesn't feel like the sort of direction of travel.
Okay. Well, look, guys, thank you very much. I'm afraid we're out of time. There's a ton of questions here that unfortunately we haven't got around to, so we will follow up individually with responses to that over the next 24 hours. Look, I think from listening to both Davids, I think there's obviously a very compelling opportunity within the real estate European debt market. Key themes that I'd probably pull out that you've mentioned would be the banks continuing to retrench and the likely substantial growth that we're going to see in alternative lenders following in what we've seen in the US that you both talked about. Clearly, it's now the end of zero interest rates. And I think we're now really back to a norm around the long-term averages. And finally, I think, from a risk return point of view, I think, low teens returns at sensible LTVs, is a very attractive opportunity for investors to be able to participate in. So with that, I'd like to say a big thank you to both Davids for sharing their expert insights with us. If you want to follow up or there's any additional questions, please come back to us. Otherwise, thank you very much for joining, and we will be in touch soon. Many thanks.
Cheers.
Thank you. Bye-bye.